The phrase monetary policy refers to the activities taken by central banks to control the amount and pace of increase of the money supply that's accessible in the economy and to achieve desirable outcomes like low inflation, low unemployment, and stable financial systems. In 1913, the Federal Reserve Act established the Federal Reserve System as the United States Central Bank. Its main responsibility is to carry out monetary policy in the country in order to support maximum employment, stable prices, and moderate long-term interest rates in the American economy. Its duties also include acting as the lender of last resort, promoting financial system stability, and regulating financial institutions. The Federal Open Market Committee, FOMC, which is composed of the Federal Reserve Board of Governors and 5 out of the 12 presidents of Federal Reserve banks, determines the monetary policy of the United States, which is implemented by all 12 regional Federal Reserve banks. The Federal Reserve Board attempts to safeguard price stability by regulating the amount of money in circulation. Therefore, through a variety of routes, monetary policy influences economic development in a stabilizing manner. The upkeep of price stability is monetary policy's contribution to long-term sustainable growth. Since a significant portion of persistent price increases is considered to be a monetary phenomenon, monetary policy employs its instruments to effectively control money supply, with the goal of preserving price stability over the medium to long term. Lowered price levels are thought to be connected with long-term, sustainable growth, according to theory and current data in the literature. Financial circumstances in the economy are greatly influenced by monetary policy, not just in terms of costs, but also in terms of loan availability, banks' willingness to take certain risks, etc. The pricing of commodities, the value of assets, currency rates, as well as consumption and investment are all impacted by expectations about the future course of the economy and inflation. For instance, a change in monetary policy that lowers interest rates reduces the cost of borrowing, which boosts investment and the purchase of durable goods. Economic lag caused by rising interest rates is evident in housing data. Markets gain on new economic information. Last year, the US trade deficit nearly reached $1 trillion. According to data released by the Commerce Department, the fourth quarter of 2022 saw an annual growth rate of 2.9% for the US gross domestic product after accounting for inflation. This was somewhat lower than the third quarter's growth rate of 3.2%. The foundation of the American economy, consumer spending, expanded at a rate of 2.1%. The information is provisional and will be updated at least twice more in the months to come. The robust fourth quarter growth brought an end to a year in which economic production shrank in the first half, sparking concerns about a recession, then increased in the second half. GDP increased by 1% for the whole year, compared to 5.7% growth in the fourth quarter of 2021, as evaluated from that quarter's fourth quarter. The most variable parts of GDP historically, commerce and inventories, drove the seesaw trend in 2022. Economists claimed that the wider picture was less complex. The pandemic recession recovery has slowed down from the frenzied speed of 2021, but it has remained resilient in the face of the war in Europe, global inflation, and a rash of aggressive interest rate rises by the Federal Reserve at home. In comparison to much of the rest of the globe, the United States saw a significantly better early recovery from the pandemic recession. By many standards, inflation is still too high, and the Fed is anticipated to keep raising interest rates to try and rein in prices. However, higher interest rates have not yet weighed on the US economy. However, there is a noticeable impact on housing. The housing industry, or residential fixed investment, fell at an annual pace of 26.7% in the fourth quarter, subtracting 1.3 percentage points from overall GDP growth. The huge contraction came after an even greater drop in the third quarter and a much milder drop in the second. Overall, the industry concluded 2022 roughly a fifth smaller than it began the year. In December 2022, the Federal Reserve, Fed, completed a year of major policy swings by raising its rate to a range of 4.25% to 4.5%. Since March, the Fed has shifted its target rate away from 0%, which it had held for 2 years, all in an effort to combat continuously rising inflation, which began in 2021. Earlier in 2022, the Fed discontinued its purchases of Treasury and mortgage-backed securities in order to increase liquidity in the financial markets. From a height of about $9 trillion, the Fed began to reduce its balance sheet of such assets. This quantitative tightening method, in conjunction with interest rate rises, is intended to control inflation by limiting economic growth. The latest rate rise comes despite evidence of reducing inflation in the last months of 2022. Living costs, as assessed by the Consumer Price Index, climbed 7.1% during the preceding 12 months through November, a 2% decrease from the peak set in the 12-month period ending in June 2022. Nevertheless, Powell remarked following the December FOMC meeting, inflation statistics received so far for October and November suggest a welcome slowdown in the monthly rate of price rises. Powell went on to say that the Fed wanted much more data to be confident that inflation is on a sustained declining trend. Amid signals that the Fed will continue to raise interest rates, Horwath says it's impossible to call this tight monetary policy. The Fed is looking at inflation indicators that are still at 5% or more, which is over the current Fed funds target rate, he says. The Fed may consider that raising the Fed funds rate above that level will have a more substantial impact on the inflation threat. Higher interest rates are meant to restrict economic activity as part of an effort to moderate the rising inflation rate. Forecasts from economists are noteworthy because they highlight the possibility that the Fed's rate estimates may still be inaccurate. In fact, according to the majority of economists, 62%, officials will need to raise interest rates even higher than the median forecast made by the Federal Reserve. And according to the most pessimistic estimates in the survey, 6 to 6.25%, rates will surpass even the highest forecast made by the Fed by half a percentage point, 5.5 to 5.75%. However, the most subdued rate projections from Fed officials, 4.75 to 5%, outperformed the lowest forecast made by analysts, 4.5 to 4.75% in Bankrate's survey. It demonstrates that some experts, albeit to a lesser extent, believe rates might also surprise on the negative side. One point on which economists and the Fed are substantially in agreement is the impossibility of rate decreases in 2023. According to the majority of economists, 62%, the Fed won't start lowering interest rates until 2024, which is in line with its projections. The US Central Bank predicts that interest rates might reach 4 to 4.25% by the end of the following year. Before lowering rates, the Fed will want to be certain that its rate rises are bringing down inflation, predicts Bernard Markstein, President and Chief Economist of Markstein Advisors. It's reluctant to cut rates too soon. As a result, the Fed won't cut rates until 2024. Even though the Fed actions necessary to reduce inflation may have immediate consequences for individuals and businesses, they will help restore price stability and establish the groundwork for robust economic development and low unemployment. The US government may engage in reforms to increase the size of the labor force, increase productivity, and encourage investment and innovation through fiscal policies to boost growth over the medium to long term. Increased government funding for paid family leave, childcare, preschool, and access to a college education could be among them. Other examples include tax credits that encourage women, minorities, and low-income workers to enter the workforce, as well as immigration reform that aims to increase the labor force and improve skills. If you enjoyed this video, do not forget to like and subscribe to our channel so we can bring you more exciting topics like this. Until next time, do take care and stay safe.